There are old traders and there are bold traders, but there are very few old bold traders. Many think bigger risks equal bigger rewards. And in trading, that belief destroys more accounts than anything else. Swing harder, win bigger. It's how we're wired. And in trading, that belief destroys more accounts than bad analysis, terrible timing, emotional decisions, and everything else combined. Let's discuss why the aggressive approach feels right, but consistently fails, real stories of traders who learned this the hard way, the psychological trap that keeps you doubling down when you should be pulling back, and what actually separates the winners from everyone else. Let's start with the thing that wrecks most traders within their first year. You've heard it before. Risk only 1 to 2% per trade. And you probably thought, yeah, but that's for people who are scared. I'm here to actually make money. I didn't get into trading to play it safe. I get it. It sounds boring. It sounds like you're leaving money on the table. Here's the problem with aggressive trading. When you're risking big, let's say 10% per trade because you've got conviction, a bad week absolutely destroys you. 5 losses in a row and you've lost almost half your account. You're sitting there staring at a balance that's been cut in half, and the psychological damage is even worse than the financial damage. Now you're not thinking about making money anymore. You're not looking for opportunities. You're thinking about getting back to where you started. And that's a completely different mental game with completely different emotions. The safe trader who risked 1% per trade, 5 losses barely dents them. They're down 5%. They're annoyed, sure, maybe frustrated, but they're not in a hole. They're still playing offense, still looking for the next good setup. One trader is trying to survive. The other is still trying to win. That's the entire difference right there. And here's what makes it even worse. Getting back to even from a 50% loss requires a 100% gain. You have to double what's left just to break even. The safe trader losing 5%, they need a 5% gain to recover. One trader needs a miracle. The other needs a decent week. Let me tell you about Jesse Livermore because his story perfectly captures what happens when position sizing goes wrong. In 1929, Livermore became a legend. He shorted the market right before the crash and made the equivalent of about $1.5 billion in today's money. Think about that. He was one of the most famous traders in the world. People wrote about him. Other traders studied his every move. He was the guy who figured it out. 5 years later, he declared bankruptcy. How does that even happen? How do you go from effectively being a billionaire to broke in 5 years? He got sloppy with his position sizing, started taking massive positions when he felt certain about a trade. He confused a winning streak with being invincible, started thinking the rules didn't apply to him anymore. The market humbled him hard, and he ended up losing everything, not once, but multiple times throughout his life. Before he died, he wrote something that still haunts me. My life has been a failure. Think about that for a second. The man who once controlled enough capital to move entire markets, who made more money in a single trade than most people see in a lifetime, died broke and broken because he couldn't stop betting too big. That's not a strategy problem. That's not a market analysis problem. That's a survival problem. And it's the same problem that kills retail traders every single day. Here's what happens when you trade aggressively. And this is important because it explains why smart people keep making the same mistakes. You risk big and win. Your brain floods with dopamine. It feels incredible. You feel like a genius. You feel invincible. And you want that feeling again. So on the next trade, you go even bigger. Why wouldn't you? You just proved you can do it. Then you lose. And losing hurts way more than winning feels good. This isn't just a saying. It's actual neuroscience. The psychological pain of losing is about twice as strong as the pleasure of an equivalent win. So now you're in a hole, and your brain is absolutely screaming at you to win it back immediately. You can't think clearly. You can't be patient. You just need to get back to even. So you size up even more, trying to recover in 1 or 2 trades. This is called revenge trading, and it's how most accounts actually die. Not for bad strategy, not from poor analysis, from emotional decisions driven by position sizes that are too large. Safe trading removes you from this entire emotional nightmare. When you're only risking 1% per trade, your emotional response is muted. A loss is annoying, not devastating. You're not spiraling. A win is nice, but you're not getting high on it and making stupid decisions on the next trade. You stay clear-headed. You stay rational. And in trading, rationality is literally everything. The market doesn't care about your emotions, but your emotions determine every decision you make. I knew two guys who started trading around the same time. Both had $25,000 to start. Both studied the same YouTube channels, read the same books, practiced on the same simulators. Both were pretty decent at identifying setups. On paper, they were the same trader. Trader A wanted results fast. He was tired of his job, tired of the grind, and he saw trading as his ticket out. So he risked 5% per trade because he wanted to make it happen. He needed bigger wins to justify the time he was spending. After 6 months, his account was down to $8,400. One particularly bad month almost wiped him out completely. He was stressed all the time, couldn't sleep properly. His girlfriend noticed he was always on edge, constantly checking his phone. Trading was consuming his entire life, and not in a good way. Trader B took a different approach. Risked 1.5% per trade. Trader A called it boring money. Said he'd never get anywhere trading that small. But Trader B didn't care. He had a day job he didn't hate, and he was just focused on being consistent. 6 months in, Trader B's account was at $31,200. Nothing spectacular happened. No massive wins to screenshot. No huge days. Just steady, boring growth. Here's what really matters, though. Trader B slept fine every night. His worst drawdown was barely noticeable, something like 11%. A couple bad weeks, but nothing that kept him up at night. Trader A's account got cut more than in half. Twice. His relationships suffered. He snapped at his kids over nothing. He was drinking more. Trading wasn't making his life better. It was destroying it. A year later, Trader A quit. Told everyone that trading was too stressful and too risky, and probably a scam anyway. Convinced himself the market was rigged against retail traders. Trader B is still trading today, 5 years later, with a 6-figure account. He eventually quit his day job, but not until his trading account was large enough that it felt safe. Same strategy, same market, same starting capital, different position sizing, completely different lives. March 2020. COVID hits and markets absolutely lose their minds. I'm talking chaos. Stocks moving 20, 30, sometimes 40% in a single day. Circuit breakers getting triggered. The VIX, the market's fear index, spiking to levels we hadn't seen since 2008. If you were risking 10% of your account per trade, and you were on the wrong side of one of those moves, you could lose 30 or 40% of your entire account in hours. Not your position, your whole account, because stops were getting blown through, slippage was insane, and the volatility was eating people alive. I watched it happen. People who thought they had tight risk management suddenly had positions going way past their stops because the market was moving too fast. Traders risking 1% per trade? It took its too. Don't get me wrong. But a 30% move against a 1% position is a 3% account hit. Painful, but you're still in the game. Here's the really brutal part. That crash only lasted about a month, maybe 6 weeks. Then markets started recovering, and they recovered fast. If you survived that initial drop, the opportunities on the way back up were incredible. The safe traders survived and made fortunes on the recovery. Some of them had their best months ever. The aggressive traders were already out, sitting on the sidelines with blown accounts, watching everyone else get rich, try to figure out how to save up enough money to get back in. Volatility doesn't care how confident you are. It doesn't care how good your analysis is. It just eats aggressive position sizes for breakfast. You want to know what real professional traders risk per trade? The ones managing millions and billions of dollars? Most risk between 0.5% and 2% per position. That's it. The really successful hedge funds and prop trading firms? Some of them go as low as 0.25% on individual positions. Let that sink in. These are people with entire research teams, advanced algorithms, real-time data feeds, decades of experience, access to information retail traders will never see. And they're playing it safe. Why? Because they've learned something that retail traders refuse to accept. Staying in the game is more important than any single trade. Survival is the prerequisite for success. Paul Tudor Jones has been absolutely crushing it since the 1980s. One of the greatest traders alive. His rule? If you have a losing position that's making you uncomfortable, the solution is very simple. Get out. That only works when your positions don't terrify you. When you're risking 10% per trade, every single position is terrifying. You can't cut losses quickly because each loss is devastating. So you hold and hope, which is how small losses become account-ending disasters. Here's something that doesn't get talked about enough, and it's honestly one of the most important concepts in trading. When you take a massive loss, you're not just losing money. You're losing time. And time is the one resource you absolutely cannot buy back. Say you lose half your account. Even if you're genuinely good at trading, even if you're making solid, consistent returns, getting back to where you started takes years. Literal years of your life just trying to get back to break even. Lose 10% of your account, you recover in months. But there's an even deeper cost. Every month you spend recovering from a massive loss is a month you're not compounding. A month where your money isn't working for you. A month of opportunity cost. If you blow up your account and it takes you 2 years to get back to where you started, you didn't just lose 2 years of time. You lost 2 years of compound growth. 2 years of market opportunities. 2 years where you could have been building real wealth. Aggressive trading steals your time. And time is the one ingredient you absolutely need to build wealth. You need years of consistent compounding. You need to be in the market with capital when opportunities show up. Every massive loss sets you back years. And most people don't have decades to keep restarting. But what about those massive wins? What if I catch a runner and the trade goes 10-1 in my favor? I hear this all the time. It's the main argument for aggressive sizing. And I get it, it's seductive. Risk 1% and catch a trade that goes 10-1. You make 10% on your account. Nice win. Risk 10% and that same trade makes you 100%. You double your money on one trade. That sounds way better, right? Except here's the reality. You will never make it to that trade. The losses along the way, and there will be losses, even for the best traders, will have already destroyed your account before you ever see that 10-1 winner. Think about it. To even get the opportunity to catch that big winner, you need to take hundreds of trades, maybe thousands. And during that journey, you're going to hit losing streaks. Everyone does. It's just part of trading. If you're risking 10% per trade, a normal losing streak ends your account before you ever get the chance to hit that big winner. Safe trading keeps you in the game long enough to actually catch those runners. Because they do happen, but only if you survive long enough to take the trade in the first place. The aggressive trader is mathematically eliminated from the game before they can benefit from the upside they're chasing. That I watched this happen in real time, and it's burned into my memory because of how quickly it happened. There was this guy in a trading Discord I was in. Started with $50,000. Was actually pretty good at identifying setups. Was crushing it for about 2 months. Got his account up to $71,000. Then he got cocky. Started talking about how he'd figured it out. Started posting screenshots of his daily P&L. Started risking 8% per trade because, in his words, when you know, you know. Then he hit a rough patch. 5 losses in a row. It happens. His account dropped to $45,000. And this is where it gets ugly. He panicked. Started posting in the Discord about how he needed to make it back. Started risking 15% per trade to recover faster. Said he couldn't afford to grind it back slowly. 3 more losses. Account dropped to $26,000. Now he's completely desperate. Started taking trades that didn't even match his strategy. Risking 25% per trade on pure emotion. Within 6 weeks of his peak at $71,000, his account was under $3,000. He posted one last message, something about how trading was impossible for retail traders, and then he disappeared from the Discord. I think about him sometimes, because he was actually good at trading. His setups were solid. His analysis was sound. But none of that mattered once he entered the death spiral. This is the pattern, and I've seen it dozens of times. Big position sizing leads to big losses, which leads to bigger position sizing to try to recover, which leads to catastrophic losses. the death spiral. Safe traders never enter it. They can't, because they never take that first devastating hit that starts the panic cycle. When you know that no single trade can hurt you, everything about your trading improves. You're not hoping. You're not praying. You're not staring at charts, sweating, moving your stop loss because you can't afford to take the hit. You just execute your strategy. Take the trade. Manage it according to plan. Move on. This psychological freedom improves every aspect of your trading. Your entries are cleaner because you're not hesitating. Your exits are sharper because you're not emotionally attached. You follow your rules because there's no reason not to. Aggressive traders can't do this. They're too emotionally invested in every single trade. When you've got 10% of your account on the line, you can't be objective. You start seeing what you want to see. You move your stop loss because you need this trade to work. You exit winners early because you need the dopamine hit and the relief. Their strategy might be fine. Their analysis might be solid. But their psychology is destroyed by their position sizing. And here's what really matters. This psychological edge compounds over time. Every trade you execute perfectly builds confidence. Every time you follow your rules exactly, it gets easier the next time. You're building a track record of discipline. You're proving to yourself that you can be trusted. The aggressive trader is building a track record of panic, hope, and regret. Even when they win, they're reinforcing bad habits. The win was stressful, so the next trade is stressful. The cycle never ends. Over months and years, the psychological gap between these two traders becomes massive. One is calm, confident, and consistent. The other is anxious, impulsive, and erratic. Same markets, same opportunities, completely different experiences. Warren Buffett has two rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It sounds simple, almost too simple, but look at his actual track record. He's been investing for over 70 years. His worst drawdown, the most he's ever lost from a peak, was about 50%, and that was during the 2008 financial crisis when the entire global financial system was collapsing. Most years, his drawdowns are small, single digits. He's not trying to hit home runs every quarter. He's not swinging for the fences. He's focused on not striking out. And because he never strikes out, he gets to keep compounding. Year after year, decade after decade. Same principle applies to trading. The traders who become wealthy aren't the ones swinging for the fences. They're the ones who stayed in the game long enough for compound growth to do its thing. And compound growth only works when you're not constantly digging yourself out of massive holes. Let's get practical and realistic here. No hype, no nonsense. You start with $10,000. You're decent at trading, nothing special, just consistent. You're not catching every move. You're not a savant. You miss plenty of trades. You take some losses. You're just a regular person who learned to trade and respects risk. You risk 1% per trade. You're slowly growing your account. Some months you're up 3%. Some months you're up 8%. Some months you barely make anything. Some months you're down a bit. But over time, you're trending upward. Year 1, your account grows to maybe $14,000. Not life-changing. You still have your day job. Year 2, you're at $20,000. Starting to feel real. Year 3, you're at $30,000. Now you're paying attention. Year 4, you're at $47,000. Your friends are asking how you did it. Year 5, you're looking at $75,000. Maybe more if you had a good year. These aren't lottery ticket numbers, but this is real wealth being built. And it's sustainable. You're not stressed. You're not losing sleep. You're just consistent. Run the same scenario with aggressive trading. Most don't make it to year 2. They blow up in year 1, or maybe early year 2. The ones who do make it longer are usually rebuilding from a blown account, learning the same painful lessons over and over. By year 3 or 4, they're exhausted, burned out, convinced it doesn't work. Meanwhile, the safe trader just keeps compounding, year after year. While everyone else is starting over, they're building real, lasting wealth. It's not exciting. Nobody's making YouTube videos titled, "I made $47 this week, trading boring." But it works. And it works because it's sustainable. Every time you blow up and have to rebuild, you miss the best opportunities in the market. Think about the COVID recovery. Think about the AI boom of 2023. Think about whatever the next big thing will be. Those moments happen whether you're in the market or not. But you only profit from them if you're actually in the game with capital. When you're sitting on the sidelines, broke, trying to save up enough money to fund another trading account, those opportunities pass you by. I watch traders blow up 3 or 4 accounts over 5 years, constantly restarting, constantly rebuilding, constantly missing the big moves because they're out of the market. If they traded safely from the start, they'd be sitting on life-changing money right now. Instead, they're back where they started. Or worse, bitter, cynical, convinced trading is a scam, telling everyone it doesn't work. But it's not that trading doesn't work. It's that aggressive trading doesn't work. The game rewards people who show up consistently, not people who show up occasionally with bags of money and a dream. Market opportunities don't wait for you to rebuild. They happen while you're sitting out, broke, trying to figure out how to get back in. And by the time you're back in the market, the opportunity is gone. The guy who finally learned. Marcus, smart guy, engineer, analytical, everything you'd want in a trader. He started trading with $75,000, his entire savings. And because he was analytical, he thought he could optimize his returns by risking more per trade. First 6 months, he risked 7% per trade. Made some money. Felt great. Got his account up to $91,000. Started thinking about quitting his job. Started telling his wife this might be it. Then reality hit him in the face. One bad month. Actually, one bad 3 weeks. Lost it all and more. Account dropped to $54,000. He was devastated. Couldn't believe it. Went over every trade, tried to figure out what he did wrong. The truth? His strategy was fine. His analysis was solid. His execution was good. His sizing was the problem. Took a month off. Didn't even look at charts. Needed to reset mentally. When he came back, he was different. Started risking 1.5% per trade. And yet it felt slow. It felt boring. He wasn't posting big wins in trading groups. Nobody was impressed with his returns. But he was consistent. 3 years later, his account is at $286,000. He quit his engineering job. He trades for a living now. Has his mornings free. Coaches his kids' soccer team. Actually has a life. He told me something I'll never forget. I wish I'd learned this lesson before it cost me $21,000 and a month of my life in pure stress. The strategy was never the problem. My ego was the problem. That lesson wasn't about reading charts better. It wasn't about finding better setups or better indicators. It was about respecting risk and understanding that survival is the game.